First, let me say how delighted I am to be here. I want to thank Corey for setting this up and for inviting me, and I want to thank all of you for showing up. From your introductions, it sounded like quite an impressive group. I'm going to try and cover three topics in sort of a brief survey fashion. The first is I'm going to talk a little bit about how the current recession has affected the status of macroeconomics as a discipline in terms of the debates that have been going on. And then I'm going to give you an update on what the Fed's actually been doing, because there's a tendency in the media to focus on trivialities with respect to what the Fed's doing, even in the financial media, and miss some of the essentials. And then I'm going to conclude with a discussion of my prediction about the Treasury default, which was the article you got the link to, and the article that good copies are available on the table. By the way, how many got a chance to actually read that? Okay, so but since a lot of this stuff is technical economics, which I'm going to try to make as accessible as possible, but if I don't succeed, you should feel free to interrupt me with questions, and I'll try and clarify things. Macroeconomics is really concerned with three different interrelated topics. Macroeconomics is the study of the coordination of the economy overall. And the topics that macroeconomics focuses on are, first of all, sustained economic growth. What causes it? What prevents it? What policies can affect it? Second is sustained inflation. What causes that? And the third is the business cycle. And of those three topics, the one on which there's the least consensus among macroeconomists is the business cycle. Macroeconomists have been debating the business cycle since before the Great Depression, and even though we know a lot more about the business cycle than we did prior to the Great Depression, there's still no consensus in sight in the profession as to exactly what is the source of the business cycle. Now, during the 1960s and 1970s, you had this classical debate between your Keynesians and your monetarists, and it covered a lot of different technical economic issues. But if you were to sort of reduce all of those to what was the fundamental difference of opinion between Keynesians and monetarists, and that was that Keynesians viewed the business cycle as a market failure that the government could fix, and the monetarists viewed it as a government fix. That the government was the cause of the problem, not the solution to the problem. And what happened is the combination of stagflation in the 1970s, which sort of empirically did in traditional Keynesian economics, the same way the Great Depression had empirically done in traditional neoclassical economics, was followed with sort of the triumph and then retreat of monetarism, because once the Federal Reserve started targeting the money supply, all of a sudden the velocity of money began misbehaving and behaving in a very erratic fashion. And so you sort of had the debate go into a phase two, a second iteration in the 1980s and the 1990s, where you had the Keynesian offshoot. They referred to themselves as New Keynesians. And the New Keynesians, Gregory Mankiw is, for instance, a New Keynesian, but he's also said that they could equally be billed as new monetarists, because basically the New Keynesians accepted the monetarist verdict on sustained inflation, that it was always and everywhere a monetary phenomenon. On that issue, the Keynesians lost so thoroughly that they don't even admit that they believed anything else. Yeah. But with respect to the business cycle, the New Keynesian position was, yeah, the monetarists are right about the money supply, so we'll use the money supply to control the business cycle, which means essentially they still thought of the business cycle as a market failure, but they were going to use monetarist means to achieve Keynesian aims. And then you also had sort of the monetarist offshoot, which was the new classical school of economists, Lucas, several business cycle theories, but one of their business cycle theories was called the real business cycle theory. And real business cycle theory argues that both the old Keynesians and monetarists were wrong. Business cycles aren't a problem with aggregate demand. They result from supply shocks from the supply side of the economy, and therefore they're neither government failures nor market failures. They're optimal. So the conclusion was the same as for the monetarists. The government shouldn't do anything. But the argument was different. And so as these two schools began debating, although they didn't converge in terms of their understanding of the business cycle, they actually began to converge in terms of their methodology. They began using more and more sophisticated mathematical general equilibrium models. These are referred to as dynamic stochastic general equilibrium models, or DSGE. With respect to monetary policy, they sort of converged on the Taylor rule, which was a rule for conducting monetary policy by targeting short-term interest rates. And so you had this. You had a lack of consensus about what causes the business cycle, emerging consensus about how to deal with it, and then the current recession just threw everything into disarray. And so what's happened is that the old Keynesian monetarist debates and the old Keynes versus the classics debates are all re-emerging, sometimes with a lot less theoretical sophistication than they were when they first took place, because history of economic thought is not a popular topic in econ departments, and therefore a lot of the people who are engaged in the debate don't know that they're debating the same subject or repeating the same arguments that have been made in the past. Now, I'm not going to try to offer an explanation for the current recession, because I think one of the reasons there's no consensus among economists is because although we know a lot about the business cycle, we don't know everything, and the historian in me, of course, would rather wait until 20 or 30 years after the event to try to figure out what happened, because our understanding of the Great Depression, of course, the most important insight into understanding the Great Depression came when Milton Friedman and Anna Jacobson Schwartz wrote their magisterial monetary history in 1963, long after the Great Depression, and revealed stuff that all economists agree about now, although there's still some disagreement. But notice how long after the Great Depression that work was written. And one of the things that's absolutely certain about the Great Depression is that it's a statistical outlier. It's sui generis. It's unique. In other words, if you look at recessions before the Great Depression or recessions after the Great Depression, the average length of the downturn is about a year. Sometimes less, sometimes more. This is true not only in the United States, it's true in other developed countries. And so the Great Depression stands out as, first of all, the downturn lasts 4 years, from 29 to 33, when unemployment peaks at 25% of the labor force, and then, of course, you have high unemployment for a decade. And so to explain the Great Depression, you need more than to be able to explain business cycles. You need to be able to explain what was unique about it. And what was unique about it was what Milton Friedman revealed, and Anna Schwartz in their book, was the magnitude of the bank panics and the money stock collapse that occurred during the Great Depression. The Federal Reserve had been set up in 1913 with the specific purpose of preventing, actually the legislation was passed in 1913, the Fed wasn't set up until 1914, but its specific purpose was to prevent bank panics, which had accompanied every previous recession. So, what happens? You get, beginning in October 1930, 1 year after the stock market crash, not only the worst banking panic in the history of the United States, the worst banking panic in the entire history of the world. Now, you might have thought that this would have created a prima facie case against the Federal Reserve. But of course, politics doesn't work that way. There's sort of this superstitious asymmetry where if the market fails, the solution is more government, and if the government fails, the solution is more government. So the Fed was actually given more power. If we take out the Great Depression and we look at business cycles, what we discover is that since the adoption of the Federal Reserve, there's one period in which, as I mentioned earlier over dinner, one period in which the Federal Reserve didn't do a catastrophic job. And that's what economists refer to as the Great Moderation. Beginning in the mid-1980s, first under Volcker and then under Greenspan, and continuing until the current recession. This period stands out in terms of the volatility of GDP, in terms of the low level of inflation in the United States, in terms of the mildness of the two recessions that took place. It really, the historians who've done research on this discover if you throw out the Great Depression, there's virtually no difference between the magnitude of recessions before the Great Depression, when the government didn't do anything, and the magnitude of recessions or the frequency after the Great Depression, when the government assumed responsibility for trying to prevent it. You only have this brief two-decade period of seeming moderation. Now, although Friedman convinced everyone that the banking panic were the factor that made the Great Depression uniquely deep, and along with the bank panics, you had an enormous collapse in the money supply over 4 years, 25%, by 25% if you look at M1, by 1/3 if you look at M2, and deflation. There's still disagreements about other issues surrounding the banking panics. There's still disagreement about what caused the initial downturn, which begins in 29. That's a regular business cycle. The banking panics begin a year after that. There's still disagreement about what caused the banking panics. Friedman argued it's Fed policy, but the Keynesians argued that can still argue it's a kind of market failure. There's still disagreement. There's not disagreement about why the Depression is so deep, but there's still disagreement, different theories about why the Depression lasted so long in terms of high unemployment. And finally, the one disagreement that the public has sort of been unaware of is there's disagreement about why the banking panics were bad. In other words, why did they result in such horrible results for the economy? And the Friedman theory is an aggregate demand theory, which says that the banking panics were bad because they caused a collapse in the money supply, and this caused unanticipated deflation, and it was the unanticipated severe and sharp deflation that caused most of the unemployment and all of the other problems. And therefore, Friedman's solution would have been, actually his preferred solution would have been the older system of allowing clearinghouses, bank clearinghouses, to issue their own money during panics, which is something that was beginning to develop in the U.S. before the Federal Reserve stymied that. But his backup solution would have been to have the Federal Reserve try to expand the money supply in order to prevent its collapse. And it's true that the Federal Reserve did begin open market operations towards the end of the banking panics, but by then it was too little, too late. So that's Friedman's solution. Then Bernanke did a lot of research on the banking panics, and he sees them primarily as supply side shocks. In other words, his argument is not with respect to deflation and a falling money supply. His argument is the banking system is a critical sector of the economy, more critical than any other sector, because it intermediates savings from ultimate savers to ultimate borrowers. And so he sees the banking panics as a supply-side hit that interrupts financial intermediation, interrupts the flow of funds, and he thinks that's the reason that they made the Great Depression uniquely severe. Now, it's clear that both things happen. So the question is, which is the most important in your analysis? go with Ben Bernanke, then the solution is not so much to, or is not only to prevent a fall in the money supply, it's also to prevent a collapse of the financial system with targeted bailouts. And that is different than what Milton Friedman would have had in a similar situation. And I'll show you how that plays out in a minute. Because now we're going to get to an update on what the Fed's been doing under Ben Bernanke. Now the first thing is you have to understand how the Fed works, and you probably all do, but just in case, what I like to tell my students is you should think of the Fed as a giant legalized counterfeiter. And if you do that, you'll never make a mistake on whether the purchase of Treasury securities increases the money supply or decreases the money supply, because whenever the Fed purchases anything or loans out money, it creates it. It creates it out of thin air. And so when the Fed sells stuff, it pulls money out of circulation. And if the Treasury were doing this, if we had a simple fiat money system, simple fiat money similar to what was issued by the colonies during the American Revolution, when the government just printed up money and spent it, this would be clear. Or during the Civil War, when the Treasury just printed up greenbacks and spent them. But because we have central banks, the central banks, rather than spending the money directly, loan the money out. But of course, their primary customer is the Treasury. So you got two arms of the government, one of them creating money, loaning it to another arm of the government, which then spends it. And if you consolidate the balance sheet, it would work out the same as simple fiat money. And the technical term for the Fed loaning money to the Treasury is open market operation. Because you see, if the Fed loans out money that is created, it essentially has two sets of customers, or at least in the past, traditionally has any central bank. There's two sets of customers, private banks, and loans to private banks are called discounts. And then loans to anyone else on the open market buying securities are called open market operations. And actually, it's not a new innovation for the Fed to buy private securities on the market in engaging in open market operations. Up until 1974, the Fed purchased bankers' acceptances on the open market and had done so at the time of the Great Depression. But in general, until Bernanke, when the Fed does open market operations with the purchase of Treasury securities, comes up that I'm going to show you is the part of the money supply that the Fed controls. The Federal Reserve, much of the money that's in circulation, in fact, most of the money that you hold is privately created by banks. If you compare your holdings of the Federal Reserve notes and Treasury coin with your deposits at the bank, nearly everybody holds more in the form of privately created money than the central bank created money. But the central bank, the part of the money supply that the central bank, the Fed, controls is known as the monetary base, or sometimes high-powered money, or sometimes even a more arcane term, outside money. And this is showing the growth of the monetary base and its two major components during the Great Moderation. Actually, we're starting in 1979, and it's going to 2008. And the red line shows a pretty rapid increase in the monetary base in this period of relatively low inflation. But the monetary base has two components. The reserves of banks, and I'm including all vault cash as well as their deposits at the Federal Reserve, and currency in circulation. This is a logarithmic scale. The green line is the reserves of banks, and the blue line is currency in circulation. So that you see, under Greenspan, and Greenspan comes in right about here, under Greenspan, the entire increase in the monetary base is a result of an increase in currency in circulation. Now that should seem surprising, because with debit cards and ATMs, people don't seem to be using a lot of, don't seem to be significantly increasing their use of currency, and in fact they aren't. The estimates are that most of that currency was going abroad. So that at the beginning of this period, about 25% of U.S. currency was held abroad, and by the end of the period, about 50% of U.S. currency was held abroad. Now, you'll notice that once Greenspan comes in, the level of reserves remains fairly constant. Right? And these two spikes in reserves, first one is Y2K, and the second one is 9/11. See, that's a Friedmanesque response to the whiff of a panic, which is, in each case there was concern that there would be a scramble for liquidity. So Greenspan initially floods the system with liquidity and then pulls it back out. Now the critical debate, or the critical date, pardon me. By the way, this shows the rate of growth of the three components of the monetary base, not their levels. And reserves look a whole lot more volatile, but look, notice during the period when Greenspan was supposedly carrying out a significantly expansionary monetary policy, the rate of growth of everything is declining, not increasing. You do have one spike here in the increase in the rate of growth of reserves, which suggests that Greenspan might have had a small role in the housing boom, but that level of mistake, if we can call that a monetary mistake, it is really too small compared with previous monetary mistakes to be given much responsibility for that housing boom. So I don't think Greenspan's getting a bum rap. But in any case, the critical.
Jeff, what is the green line? I don't see it.
The green line represents the rate of growth of reserves.
Okay.
It's the same colors as before. So the blue line is the rate of the red line is the rate of growth of the monetary base. The blue line is the rate of growth of currency, and the green line is the rate of growth of reserves. So even though reserves were flat, there is fluctuation. But part of that fluctuation is because the reserves are such a smaller magnitude to begin with. In any case, critical date is Thursday, September 18th, 2008. That's when Bernanke and Paulson hit the panic button and got President Bush to try to calm the public by telling them that the economy was about to collapse. And what made them hit the panic button at that point, the recession had already started, although there was still debate about whether there was a recession. But what made the Fed hit the panic button at that point was a scramble for liquidity that showed up in three markets. First of all, the interest rate on Treasury bills temporarily went negative. Secondly, the TED spread, the Treasury Euro-dollar spread, the spread between interest rates on Treasuries and Euro-dollars, went sky high, which represents default risk. And third, the LIBOR OIS spread, the LIBOR London Interbank Offered Rate, and the OIS is Overnight Index Swap Rate. That measures a maturity spread between short-term and long-term, and that went through the roof. And that convinced Bernanke that drastic action was needed. So the next graph shows you what happened to the monetary base. Yeah. And that was within a period of about 3 or 4 months. Since then, it has stabilized.
It's picked up a lot last couple of
weeks. It's picked up a lot the last couple of weeks, but nothing like this. Nothing like this. So the blue line represents the total monetary base. That was being shown in the graph before. And then you can see the reaction to what Bernanke starts to do in October. And then this just shows you the rate of growth. Now, under normal circumstances, right, this is going to lead to a lot of inflation. But, of course, it doesn't lead to a lot of inflation.
Yeah.
All right, here are the monetary aggregates, And at the right-hand side, 2008, 2009, you can see that M1 shows a little bit of the effect of the Bernanke explosion. Now we no longer have M3, but we have MZM. MZM is the green line, which is reported by the St. Louis Fed. And it's essentially M2 subtracting out all small time deposits and adding in institutional money market mutual fund share. But you can see there's very little impact of the increase in the base on the levels. This is the rate of growth. You can discern a little bit more of an impact there, especially on M1. But still, if you go back to the rate of growth that was occurring in the 2001 recession, it's not unprecedented. And the question is, why doesn't this result in significant inflation? And the answer is that buried within the TARP, which passed on October 3rd, 2008, was a provision that Bernanke had explicitly asked for, which was the power to pay interest on the reserves that banks are holding. Now, the Fed was actually scheduled to get this power in 2012, but Bernanke, as an emergency measure, asked for it in the TARP, and then it was instituted almost immediately. Well, you know, if you're going to pay interest on reserves, that gives these banks an incentive to hang on to reserves. So what happened is Bernanke simultaneously initiates a major inflationary step with the explosion of the monetary base and a major deflationary step by paying interest on reserves, although there are other reasons that banks may have been holding reserves. And so far, they've been in balance. Now, why did Bernanke do this? Well, it has to do with the difference between Friedman's view of how to handle a recession and Bernanke's view. See, Bernanke, remember, the recession begins, the stringency in financial markets begins in the last quarter of 2007. And if you remember back then, there were also concerns about inflation taking off because of what was happening to oil and other commodities. And so Bernanke wanted to keep inflation under control, but at the same time, he wanted to bail out the financial system. Now, we mentioned that in the past, or I mentioned in the past, that the Federal Reserve sometimes can loan money to banks for discounts. But by the time, throughout most of the post-World War II period, that's been a trivial source of increases in the monetary base. Less than 1% of the assets of the Fed have generally been discounts, loans to banks, whereas 80 to 85% have been treasury holdings of treasury securities. And Bernanke wanted to change that. So one change that had been made even before the recession was, for a long time, banks getting discounts from the Fed, there was a stigma to it, attached to it, and the Fed rationed discount. And the Fed, as a result, held the discount rate below the federal funds rate. So the banks had an incentive to go, but then they had a disincentive because they went to the discount window too often. All of a sudden, they might get more inspectors coming in to visit, and other problems. So banks didn't want to. Banks preferred borrowing reserves from each other on the federal funds market rather than going to the Fed to the discount window.
Excuse me, you meant above, not below. The discount rate is above the federal funds rate.
Yeah, I'm sorry, above. Yeah, sorry, above. All right, so then, thank you. It's always good to have a sharp student.
Hey, I
in the class. All right, so what happened is the Fed, before the current recession, changed their discount policy. And because of their effort to target interest rates, and moved the discount rate below the federal funds rate. And no.
It was started below.
It was started below. I was right. It started below, and then they moved it above the federal funds rate. They moved it above the federal funds rate, but they said there's no longer a stigma attached. You can borrow as much as you want. And this is part of targeting interest rates. You see, they have a federal funds target, but they don't hit their federal funds target perfectly because they don't set the interest rate. And this is something else that is very misleading about the newspapers. The federal funds rate is a market set rate. Banks can negotiate it at any level they want. And if you look at the federal funds rate at any particular time, you will have, first of all, the Fed's target rate, which it tries to meet by engaging in open market operations, and it's a big player in that market, so it has a big effect on the price, just as the Army is a big player in the shoe market during a war and will have a big effect on the price of shoes, but that's not setting the price, and sometimes the average federal funds rate is not at the target, and also you'll see a large range of federal funds transactions both below and above the target, depending on what banks negotiate with each other. So in order to be able to hit the target more precisely, the Federal Reserve decided to put the discount rate above the federal funds rate and open it up to anyone, right? And that would prevent the federal funds rate from going any higher than the discount rate, because then banks could go to the discount window and get money more cheaply. That was the idea. The banks didn't buy it. They didn't trust the Fed. So they were still reluctant to go to the discount window. As a result, in December of 2007, Bernanke initiated the term auction facility, in which the Fed now, in order to get the banks to borrow money, rather than setting an interest rate and letting the banks determine how much money was borrowed, the term auction facility involves the Fed taking a whole bunch of money, potential reserves, and auctioning it off to the banks. So now the Fed determines how much money gets injected, and the banks, through their auction, determine what the interest rate would be. And this was to get the banks to borrow more money because he was worried about the financial safety of the banks. And not only that, discounts in March of 2008 were extended to broker-dealers. And there was also the initiation of a program where the Fed would loan securities to brokers, dealers who needed liquidity. And then in July of 2008, of course, you had the bailout of Bear Stearns, which was done through a exotic vehicle called the Maiden Lane Limited Liability Corporation, which was sort of a structured investment vehicle underneath the New York Fed. That loaned out the money. So in essence, Bernanke is dumping money into the financial system to bail out the financial system, but he doesn't want it to affect the monetary base. So for every dollar he dumps into the financial system, he pulls a dollar out by selling Treasury securities. Now in Fed speak, he was sterilizing the injections, and you can see that here. This represents the Fed's holding of Treasury securities. Now they say that that the gray represents lending to financial institutions, but it's also including repurchase agreements, so that it's actually too large here. But you can see, beginning in this period, all of a sudden, Fed lending through the discount window to dealers through the term auction facilities begins to supplant the holding of treasuries. This is the total level of the Fed balance sheet, which basically mirrors the monetary base, and you can see that he's preventing any of his targeted bailouts from having an impact on the monetary base. He's sterilized.
So,
But
wait, Jeff. You started with you may not want to take this question now. You started with a very nice exposition of the different types of policy, monetarism, and Keynesian and everything else. When you talk about sterilization of the Bernanke's policies, are you also is it also synonymous with sterilization of the economic impact that he's trying to take on?
okay, it refers back to my distinction between what Friedman would have done and Greenspan did versus what Bernanke did. These are targeted bailouts. In other words, he's redirecting funds into the financial system because he's worried about the financial system. Whereas what you would have seen probably under Greenspan or Friedman is at this point you would have seen an increase in the monetary base, an increase in general liquidity, with less concern about where that liquidity ended up. Just providing the system with liquidity. If you provide enough liquidity and the banks know that the liquidity is there, then they're not going to worry as much about the liquidity. Whereas Bernanke thinks these institutions have problems, they're going to fail. If they fail, even if the money supply doesn't fall, if they fail, you're going to have significant financial consequences. So it's part and parcel of the too big to fail, or systemic failure doctrine, which is sort of an aberration of Friedman's account of the Great Depression, not an extension.
Okay, so this is making the balance sheets of the institutional investors and the financial companies look better.
It's giving them more liquidity, making more cash available. Okay?
If you guys can ask questions. I'm in microeconomics. I know nothing about the macro side here. But if you all understand...
And it's because Bernanke was worried about inflation. Okay, but notice, in order to continue this policy, he's got a problem here. He's running out of Treasury securities. Right? So how can you continue this process? Well, Bernanke's basic idea was that the Fed could continue to bail out the financial system without affecting the monetary base by, rather than creating money and loaning it out, borrowing money and loaning it out. In other words, becoming like Fannie and Freddie, on top of being a central bank. And in fact, Bernanke has advocated that the Fed get the power to borrow in its own name. And once it does that, it will become a plenary Fannie and Freddie. One of the reasons why I was ultimately convinced that Ron Paul was right, that the Fed should be subjected to audit, because once the Fed starts borrowing money and lending it to all sorts of institutions. Now, that power was not given to Bernanke directly, but he got it indirectly in two ways. The first way, again, something that the news media has not picked up on, was that the Treasury began issuing new Treasury securities in a special supplementary financing account that weren't designed to cover any government expenditures whatsoever. What they were designed to do was to be put on deposit at the Fed. So you essentially have the Treasury borrowing an extra $500 billion at the peak of this, depositing at the Fed. So in other words, the Treasury is borrowing money from the general public. The Fed, through its deposits, is borrowing the money from the Treasury. And then the Fed used most of that money for its currency swaps, which again were $500 billion with foreign central banks in order to provide dollars to foreign central banks. So that was one way of indirectly borrowing money and relending it without affecting the monetary base. And so that's something that actually, when I showed the explosion of the monetary base, that doesn't even show up there. Now that program has been wound down.
Sorry, one more question. Maybe you guys all get it, but I didn't get what he just said. It sounded like Madoff. Okay, what you just said. So, could you just...
No, think of it like Fannie and Freddie. Okay,
slower.
think of it as like Fannie and Freddie. All right? These are government set-up intermediaries. They borrow in their own name and they relend the money.
Okay.
So they're like a bank, right? They're like many financial intermediaries, a finance company, right? All these financial intermediaries intermediate the flow of funds. They borrow on one end of the balance sheet and relend on the other. They don't create any money. So, and then the Treasury can borrow money and loan it out. Now the Treasury does a little bit of that, but not very much. So what happened here is the Treasury was borrowing money and not using it to cover its expenditure because it didn't need the money, loaning it to the Fed by depositing it at the Fed, and then the Fed was loaning it out. So it was a complex financial intermediation. All right? Clear?
So what Friedman and Greenspan would have done is to replace the gray, the blue, and this other color by all light brown.
Yeah, all light brown and start to go up
Yes.
here. Yes.
Okay, I got it.
Okay? Now, the second way, of course, of indirectly borrowing without having a monetary effect was by paying interest on reserves. Right? Because now you're providing the bank with reserves, but by paying interest on it, you're essentially borrowing money from the banks and then relending it. And as a result, and that's what caused the explosion here, all right? The increase in the monetary base, but most of the entire increase, almost the entire increase, was in the form of reserves held by banks on which the Fed pays interest to those banks. With the result that now M1 has more than 100% reserves behind it. All right? So that's phase two, and that's where you see the big jump. Now, this breaks the lending programs down into more fine categories, and I don't know how much detail you want, but some of this is in the form of lending to AIG and Bear Stearns and loans to money market mutual funds. And, yes, you have a question?
The original graph we were looking at, if you were to look at it today, is it dramatically different?
The original graph actually goes up to today. And you can see what's happened is that there's been a decline in lending to financial institutions, but this is called, that blue area is in the category that Bernanke calls liquidity to key financial markets. And so some of the things there are, first of all, the Maiden Lane 1, the lending to Bear Stearns, the lending to AIG with Maiden Lane 2 and Maiden Lane 3, the asset-backed commercial paper money market mutual fund liquidity facility, the commercial paper funding facility, and the term asset-backed securities loan facility. So those are all kinds of loans to financial institutions. And then the brown area, the upper area, is the long-term securities purchases. That's when the Fed began buying federal agency debt and mortgage-backed securities directly. Now again, the buying of federal agency debt, in other words, the debt of Fannie and Freddie government-sponsored agencies and government-owned agencies is not unprecedented. The Fed's always had some of those securities on its balance sheet, but this represents a huge increase. And then this here, this is a little bit misleading. The light brown area, they label it as the purchase of long-term Treasury securities rather than short-term Treasury securities. But the Fed has always had a mixed portfolio of Treasury securities. So if you actually broke down Treasury holdings here, you'd find that the Fed had maybe 25% of those in securities with a maturity of 5 years or more. So the composition is shifted, but again, it's not a dramatic change in terms of Fed holdings of Treasury securities.
Is it correct, Jeff, to say that Bernanke increased liquidity in the sense of liquidity for the banks, but didn't increase the money supply?
Right. Yes.
Because there are two meanings of liquidity.
Yeah, you're right. Fair enough.
Does that mean you're not worried about inflation?
Well, what it means is...
Before you leave, though, is that we'll go forward. The value of those assets, is there any comments about the value of the Maiden 1 and Maiden 2, AIG? Are those real assets? Are those loans that are going to be paid back?
There have been some losses, but not significant losses on them. And that's the one thing that the Fed always has lots of details about, is the losses. In fact, every one of these new initiatives, or most of these new initiatives, the Fed reports its balance sheet every week. And you can go online and get it. The last one was yesterday evening. And then they have special sections on some of these things, like the Maiden Lane and the commercial paper lending facility, and you can go and see exactly how much they've lost. And the losses so far for the Fed haven't been at all that significant. I think the most significant losses, I haven't actually checked the numbers, but I think the most significant losses relate to AIG.
So I guess what I'm asking is if the Fed was subject to mark-to-market accounting,
Wouldn't make a big difference.
it wouldn't make the
It wouldn't make a big difference. Well, now I have to backtrack on that. Because the Fed is obviously buying some things that may not have markets, and then we have to go to the accounting principles of how you value things that don't have markets. So it might make a small difference. Now, will there be inflation or deflation in the future? And the fact is, no one knows. That's why economists are all over the map. Some are predicting future inflation. Some are predicting, even still, although that has become less common recently, future deflation. And of course, Bernanke, in what I consider to be one of the most egregious examples of central planning hubris on the part of any Fed chairman, thinks that he can balance these things out perfectly to prevent either. And he can, because now he's got two tools, right? He's got, first of all, buying and selling, changing the monetary base, and also changing the interest rate on reserves. So the view is that he can
So what you just said means that everything I've been telling my clients for the last 7 months is that get all their loans they have right now that they can go up and down, and they can get fixed loan, 30-year, 4 3/4 to 5 1/4 loans. A lot of them have been doing that because what I was looking at, say within 3 to 4 years, I think we're looking at 6 to 8% interest rate. So therefore, they better start, getting better rates than they have. It could even go up to 9.
Yeah.
And so you're saying maybe that's not true. And
Yeah. Well,
they might spend a bunch of money getting all this refinancing when they didn't need to do that.
Well, you see, the luxury of being an academic is I don't have to forecast. And Lydia refers to it as pleading the Hummel fifth.
Yeah.
In other words, I could tell a good story that the recession will still get worse before it gets better, and I could tell a good story that the worst is over. And part of that relates to the next part of my story on Treasury default.
Can I put one question here?
Yeah.
If you look at the last 4, we had 4 negatives, and we just got a 3.5 gain.
Right.
If you take the 5 of them, we're a little over 11% negative. Isn't the old classic definition of a depression 10%? But have we been in a depression for this time? Nobody. And now they call it
Well,
a severe
there's no official definition of depression. And in fact, the shorthand definition of recession, 2 consecutive quarters in which real GDP falls, is not even the official definition. The official definition is actually established by a private institution or a quasi-private institution, the National Bureau of Economic Research. And they look at a bunch of indicators and they officially date the beginning of recessions and ending of recessions. But you can approximate that by 2 consecutive quarters in which real GDP falls. But I believe it was the 2001 recession in which those 2 quarters weren't consecutive. Now I forgot what question I was asking.
Well, there's 10% really.
Oh, yeah. So
Sure,
if
change
the
of term.
definition of a recession is vague, the definition of a depression is even vaguer. And so the way I define a depression is a recession that takes place when you're out of office, and a recession is a depression that takes place when you're in office. Now, the other shorthand rule I heard was not the 10% fall in GDP, but a depression is when you have a fall in output and unemployment rising above 10%.
Yeah.
And so by that definition we have a depression now. And then by that definition we have only one other depression in the post-World War II period, which is 1982, when unemployment. But still, I mean, 10% is bad. And it's bad for the post-war period, and it's certainly bad in contrast to the Great Moderation. A lot of the alarm, I think, has to do with rising expectations that resulted. In other words, if this sort of event had happened after all of the recessions in the 70s and the back-to-back recessions in 81 and 82, there would have been, I think, a less concern on the part of both the general public and the media. It wouldn't have looked as bad, but it looks really bad coming after the Great Moderation. But still, to keep it in perspective, we are nowhere near approaching what happened during the Great Depression. Okay? So, which is not to say that, a set of events going to make it happen.
To go back to Bob's other question about the 68% interest rates increasing, given that Bernanke has these two joysticks now where you can try to fine-tune the amount that gets lent out, the money supply, and the amount that gets paid out in the interest to banks or to reserve deposits, there's still that other connection now, the greater interconnectedness between the Treasury Department and the Fed, with all of these off-balance baby fund kind of institutions and stuff like that. And so when you loan out to these other agencies, aren't we incurring some obligations through the Treasury
Right.
Department?
Well, that was the point I was going to get to in a moment, which is that by paying interest on reserves, you've essentially converted what looks like monetary policy into fiscal policy. In other words, it's really fiscal policy. What is fiscal policy? When the government borrows money and spends it. So the Fed is borrowing money and spending it. So now I'm oversimplifying a little because it partially depends on the difference between the interest paid on reserve and market interest rates. But nonetheless, it is definitely blurring the distinction between monetary policy and fiscal policy, and it is eliminating seigniorage, which is the economist term for the revenue from printing up money, because you only get true seigniorage if you issue money that doesn't pay any interest. And once you start paying interest on these liabilities, then you are essentially creating a future tax liability on the part of the government. Now, as long as the Fed generates enough seigniorage to cover that, it's not going to directly impact the Treasury, but it certainly, it both obscures the distinction between monetary policy and fiscal policy, and it also creates a self-fulfilling Keynesian liquidity trap. This is what has permitted so many Keynesians, like especially Paul Krugman, to come out and say, well, the notion of a liquidity trap had actually been pretty dead among professional economists. The Japanese experience started to bring it to the surface, but now there are economists who are saying, well, monetary policy is ineffective because we're in a liquidity trap. Well, if you pay interest on reserves, you're creating a liquidity trap. Right? The liquidity trap is the demand for money is so elastic that no matter how much money you print, the public will hold it rather than spend it. That's what a liquidity trap is. So, well, if you pay the public, in this case the banks, hold the money, and then you print it, yeah, you've got a liquidity trap that only because you created one.
I'd like to ask a question about the issue that came up of bank credit issue versus monetary policy. Most of our recessions for the last, since the Great Depression, have involved some bank issues, of course. But the big key recessions were basically a monetary issue where we raise interest rates and people stop borrowing, and at that point in time business slowed down, blah, 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 blah. But this one, as opposed to those, and I've heard a number of economists talk about this, say this was different, it was more classical that occurred before the Great Depression, and that was a situation fundamentally where the banks themselves were so damaged by the problem with the what do you call the credit default swaps, the problem with real estate loans, whatever you call it, that they were so destroyed that they were not able to loan money anymore at that point. That's what collapsed business for a lot of small businesses. Mm-hmm. Is that why you think that Bernanke's approach has had so much credibility?
Partially, yeah. I don't want to. There are certain parallels between what began happening to the financial system and bank panics through the Great Depression, but there are also distinct differences because pre-World War II bank panics were not driven initially by banks solvency. You haven't had any depositor panics, in part because of deposit insurance. So there are some similarities and there are some differences. The one thing that I think is not, which I've been struggling with, which is not entirely explained about the current recession, is first of all the change that happened over the last 2 decades, the dramatic change in the nature of investment banks. If you go back 2 decades ago, investment banks are primarily brokers and dealers. And to the extent that they hold securities on their balance sheet, it's to facilitate their brokering and dealing. You get up to this event, and investment banks have become major financial intermediaries, in which they're not just doing brokering and dealing, they're actually borrowing money, short-term commercial paper, for repos, RPs, repurchase agreements, and then relending it. And in fact, it turns out that the amount of money intermediated by investment banks prior to this crisis exceeded the amount of money intermediated by finance companies, exceeded the amount of money intermediated by money market mutual funds. So that was a huge change in the economy, which I haven't seen fully explained. And of course, part of the problem was that even though these investment banks, their liabilities have never been counted in the money supply, they are short-term, so they're borrowing short and lending long, and then they began having problems when the financial commercial paper market began to freeze up. And so that, you can think of that as somewhat analogous to a run, has similarities and has differences. And that's another thing that Bernanke was responding. Now, very quickly, why are central banks paying interest on reserves? You see, the Fed is not the first central bank to start paying interest on reserves. The European Central Bank and many other major central banks had already adopted this practice, although they didn't adopt it in the middle of the crisis. And partially, it's been this obsession with interest rates as the main indicator of central bank policy, which Milton Friedman always thought was a mistake, and I think is a major mistake. And central banks have moved from thinking about the money supply to thinking about interest rates. And so paying interest on reserves is a way of hitting their interest rate target, because now you got your federal funds target, you got your discount rate above to prevent the federal funds rate from going too far above the target, and then you pay interest on reserves, which creates a lower, so it creates a corridor, and that's the system that the European Central Bank has been using for about nearly a decade, and then the New Zealand Central Bank actually has been paying interest on reserves at its target interest rate. So it's and as I was mentioning to Pierre the other day, now I don't even remember exactly how I said it. Central banking has become the new central planning through control of interest rates. In other words, central banks are thinking of themselves as actually trying to control this market price, which I think is a huge mistake. So that's one of the reasons. The second reason is reserve requirements, by the way, have virtually disappeared as a tool of monetary policy. And in general, I think that's a good thing. There are many countries like New Zealand, Australia, Canada, Britain that have eliminated reserve requirements entirely. The Fed is scheduled to get the power to eliminate them entirely in 2012, but under Greenspan, he made them virtually a dead letter. They only apply to M1, and then he allows sweeps from M1 into M2 in checking accounts, which sort of undermines the reserve requirement. Because they were always considered taxes on banks, reserve requirements. So paying interest on reserves is another way of sort of, you can create a kind of market argument for paying interest on reserves. I don't think it's a good one. But the third reason that the Fed began paying interest on reserves has to do with the clearing system. And this is the one that's least known. Central banks run clearing systems. They would clear the checks. Now, we also have private clearing systems in the U.S. that clear checks, but you would think, that the benefit of running a clearing system is that you could do net settlements. And that's the way clearing systems operated when they were done by private clearinghouses. But most of the central banks of the world have gone to real-time gross settlement clearing systems, in which they require in other words, rather than settling at the end of the day, they settle by the minute. Now, the problem with doing that, of course, is that a bank can, all the checks against a bank can come in before the money comes in from the checks the reserves that the bank is doing. All right. So, in order to run a real-time gross settlement clearing system, the Fed has to loan huge amounts of money to these banks on an intraday basis during the clearing period. So, in essence, you've already got a system in which reserves balloon up during the day for the clearing and then come back down. And so, but this puts a lot of risk on the Fed. And so, the idea of paying interest on reserves is to get the banks to hold more reserves so that there's less intraday credit in these real-time gross clearing systems.
Can I ask a question? It's a very naive question. I'm sure the answer is very simple, but I can't imagine it. Why does the Fed have so much power on the market? Its bloated balance sheet actually is $1 trillion, and this compares with financial markets, depending what you include, of at least 10 trillion. Well, just the mortgage market is 10 trillion. So, how, without this corridor there, how could the Fed?
Yeah, well, my view is that the Fed's ability to determine interest rates is exaggerated, and as globalization as the world becomes more financially integrated, the Fed's ability to do so. Another reason why I don't think Greenspan's responsible for the low interest rates earlier this century, because the central bank is too small a player to really, it's a noise trader in the interest rate market, so it can push it down or up a little bit, but I don't think it's the ultimate determinant, even with these extra powers.
In terms of the clearing discussion, where clearing should be a second-order effect on the whole system, but if they now have to hold the reserves to do minute-by-minute clearing, which could be as much as 5 standard deviations, is that not a significant risk item?
For whom? For the banks?
For the whole system. Because what you now end up with is you end up with the requirement to have assets to cover 3 to 5 standard deviations of activity for a millisecond in a 24-hour period. And this is exactly the phenomenon in the stock market. If you look at the normal distribution of behavior in the markets, where the people make their money is in the place between 3 to 5 standard deviations, not normal activity. So this is a system legislated boundary condition that has to happen minute by minute throughout the day.
I have to think about that. That's an interesting argument. It hadn't occurred to me.
We end up designing a system that can be impervious to all black swans.
Right.
Which means it's ultimately going to collapse, whether it's this month or next year or next decade.
Yeah, well,
punchline always seems to be the whole thing collapses.
There's some. I've only skimmed the literature on the real-time gross settlement in terms of central banks, not just the Fed, but the European Central Bank. Not only have they moved their clearing systems to real-time gross settlement, but they've been pressuring the private clearinghouses to do the same thing. And there's some market failure argument that I don't actually understand for doing it. And then George Selgin has written an interesting article refuting the market failure argument. So that's it. I'll have to think about that more. That's an intriguing point.
You go down that path. So we've had a failure right now, which has caused the Fed to argue for the second lever, which is the public paying some reserve.
Right.
Right, so then the thing fails. Then you go through another one of these crises for 10 years. Then the Fed comes up and argues for the third lever to control things. Because the basic philosophy is trying to use 1% of the stuff to control a system, which is fundamentally significant. The question to you is, what's the third lever of control of an argument?
Related to that, I wanted to ask,
That's a good question, and I have to think about that.
Okay.
That's an excellent question.
related to that is the reason that we have the second lever of control because of the velocity of money changing out of control of the Fed in terms of the technological way that we deal with money nowadays.
Yeah.
I mean, so what precluded the second lever?
Right. I actually wasn't going to talk about that, but I will. Which is, part of this argument has been the misbehavior of velocity since deregulation of the monetary system. In other words, the period that Friedman was looking at, which was up through the 1960s, it looked to be like velocity wasn't perfectly stable, but it was, it didn't vary that much, and it was a function of a small number of other variables. All right, that was Friedman's argument. And that seemed to be true for both M1 and M2 up until deregulation. Well, initially, when you have deregulation in the 1980s, you're going to have velocity misbehaving anyway, because one of the major parts of deregulation was allowing banks to pay market rates of interest in periods when demand deposits couldn't pay any interest at all, and time deposits were capped, except for large CDs, at 4 or 5% when you had double-digit interest rates. And of course, once the banks could start paying market rates of interest, they could. That's going to increase the demand for money. So especially for M1, so you're going to have velocity misbehaving then, but it continues to fluctuate. In fact, I'll show you the fluctuation of the velocity of M2 and M3 over the Great Moderation. There was this velocity bubble. But it turns out that despite the fact that reserves were fairly constant during this period, the growth of M1 and M2 was offsetting the velocity bubble. In other words, you were having a stability of MV, money times velocity. Now, I mentioned George Selgin. There are advocates of a deregulated banking system that argue that if you get rid of all government regulations and allow the banks to issue banknotes as well as currency, as well as deposits, that the mechanism of the clearing system will automatically bring this result about. That an increase in velocity, which is a decrease in the demand for money, will cause the amount of bank-created money to fall, and vice versa. And this is what appears to be happening over the Great Moderation. And so it's not Greenspan's expertise; it's his deregulation, and the market is controlling the money supply in a benevolent way. Now, if you buy that, then you have to explain why this broke down when we get to the current crisis. And I've been thinking about that, and I have some tentative ideas. And I think one culprit that hasn't been talked about is capital requirements for banks. See, prior to deposit insurance, there were some government regulations about capital requirements for banks, but they weren't very significant because without deposit insurance, having a high capital asset ratio was the way banks attracted depositors. So capital asset ratios in the U.S. for banks were in the neighborhood of 15 to 20%. And once you get deposit insurance, those plummet because there's less incentive to have high capital asset ratios to attract depositors. And then you get a justification for government regulation of these. Now, initially, the government regulation of bank capital requirements was pretty simplistic until the S&L crisis. And all the economists agreed that the S&L crisis was a result of mispriced deposit insurance. And so the solution the moral hazard problem created by mispriced deposit insurance, which encouraged S&Ls to take on excessive risk.
Yeah.
So the solution to that problem was to have the government manage the deposit insurance better by imposing both risk-based premiums, which, before that, deposit insurance had been a straight premium for all banks, irrespective of the riskiness of their portfolio. But more so, risk-based capital requirements. And so you get the Basel I, Basel II, and all of these really sophisticated attempts by the government to manage the capital of banks to prevent their portfolios from becoming too risky. And they may have done so to a certain extent, but see, one of the reasons reserve requirements have disappeared is because even though they may make banks more liquid when things are good, they make banks less liquid when a bank is facing a run. Because if you've got required reserves, you can't pay them out. So you've got to sell off assets. So the same thing is true of capital requirements. Capital requirements are a way of binding the banks and forcing them to sell off assets that they might otherwise not have to sell off in a liquidity squeeze. And so I suspect that capital requirements played a role in that. Capital requirements also played a major role in the distortion of the rating agencies in terms of their ratings. Because once you've got government-imposed capital requirements, that means you've got to measure the risk of the balance sheet. Well, you can have the government measure the risk, or you can have a private institution measure the risk. But if you're going to have a private institution measure the risk, it can't be any private institution, because then the bank will just hire any private institution that says their balance sheet is fine. So that means you've got to create a government cartel where the rating agencies have a government imprimatur, and of course, once that happens, the incentives of the rating agencies, especially to compete over reputation, is diminished. And so it's the continuing case of one regulation on top of another, creating a more and more intricate and a fragile system. And I still haven't talked about treasury default.
I want to hear about treasury default. I want to hear you make a prediction.
All right. Okay. The paying interest on reserves, what it does, oh, by the way, here is, this is showing the liability side of the Fed's balance sheet. And in the initial buildup from September to November. And the blue represents currency. In other words, the liability side is the monetary base side. The blue represents currency in circulation. These other items represent basically deposits of banks. And the brown item at the top, that is... Wait. I got to get the Federal Reserve Bank.
George, you're good if you can see those fine print there.
Okay, I got it backwards. All right. The brown is the reserves of the banks, and the purple is mainly those treasury deposits. Deposits with Federal Reserve banks other than reserve balances. In other words, borrowing from the Treasury. So that is showing. Now, as I said, that program has virtually disappeared, and that explains the recent bump in the monetary base. Is that and so the balance sheet of the Fed has remained at approximately $2 trillion, but more of it now is monetary base. Okay.
Wow.
This audience doesn't need to be told that governments do not create resources out of thin air. And there are only 4 ways that government can get resources in order to conduct activities, 3 of which are important. Sometimes people forget that the government can actually sell goods and services on the market. Right? The post office sells stamps, the agriculture department sells pamphlets, and the state of California sells lottery tickets with a monopoly. But this has never been, except for a few governments, some with a lot of oil revenue, this has never been a major source of government revenue. So the main sources of government revenue are taxation, borrowing, which represents future taxation, and creating money. And the revenue from creating money is referred to by economists as seigniorage. So what I want to do is, to give you some perspective, look at government financing during periods of high stress, government war. So this is my period, the Civil War, and this shows you the Confederacy and the Union, how much of the war's cost they covered through taxation, borrowing, and issuing money. And the Confederacy obviously had to rely more heavily on issuing money because it had a poorer economy, 52%, and of course generated the hyperinflation, whereas the Union only essentially doubled the money supply and the price level. The reason there are 2 numbers for taxation for the Confederacy is because 7% actually represents formal taxation, 17% represents the direct investment of supplies by the armies and
They just stole it.
All right, now, here we have Revolution, World War I, World War II. Notice you have another hyperinflation during the Revolution. 75% of the costs were covered. Outside of the 2 hyperinflations, all right, the highest seigniorage has ever reached in U.S. history is during World War II, where it covered 25% of the war's cost, or about 12% of GDP. Already, by the great inflation of the 1970s, despite double-digit inflation on occasion, seigniorage was only covering 2% of government expenditures, or it was 0.5% of GDP. In fact, actually, if you look at the gain that the government got from the reduction of the real value of its debt, and the fact that holders of long-term treasury securities were earning negative real rates of return, versus the gain it got from actually spending the money that it created, twice as much, 4% of expenditures were covered by the erosion of the real value of the debt. Now, what this suggests, all right, so, and the reason that inflation as a source of government revenue, all right, as a source of government revenue has become not just trivial in the United States, but trivial in all developed countries. And the reason it's become trivial in all developed countries is because all developed countries have sophisticated financial systems in which most of the money that people actually use is issued by banks, not by the government. And that constrains seigniorage, because when the banks increase the money supply, it does not generate revenue for the government, only the increase of the monetary base. So that means that if the government has a huge increase in expenditures, even runaway inflation, even inflation exceeding double digits, is not going to pay for very much. It's literally gone as a source of government revenue. All right, so let's look here. Now, this I want to give you some historical perspective on expenditures. The blue line is federal government expenditures in the U.S. from 1792 to 2008 as a percent of GDP. All right, so that means it's adjusting for inflation, it's adjusting for the growth of population, and it's adjusting for the growth of the economy. And notice you get spikes during wars. You get one here during the War of 1812. There's your Civil War. There's World War I. There's World War II. And you also have your post-war ratchet effects, which is generally government spending does not go back down to the pre-war level. And you can clearly see that after World War II. This here is the New Deal. You can see that the impact of the New Deal on government spending is actually, while significant for peacetime, is dwarfed by the impact of World War I and World War II. And the red line, we don't have good numbers on how much state and local government spent until the turn of the century. The red line adds in the spending of state and local governments. One of the most significant impacts of the New Deal was to change the locus of spending. Prior to the New Deal, I don't know how well you can tell there, but the state and local government spent about twice as much as the national government. And then since the New Deal, there have been periods in which that percentage has actually been reversed. Now, I showed that to show you this. All right. Now, this is showing federal spending. In this case, the expenditures are in red, and federal revenue as a percent of GDP from World War II to the present. Look closely at the revenue line, the blue line. Notice that since the Korean War, right, federal revenue from taxation, that's from taxes, has been bumping up against 20% of GDP for that entire period, which is an astonishing statistic when you think about it, right? Tax rates go up, tax rates go down, total bite out of the economy remains fairly constant. Which suggests that 20% of GDP is a structural limit, resulting from a combination of political and economic factors.
Do you have a guess as to why it just peaked over 20% around the year 2000?
Serendipity. No, I don't have I'd have to think about that. Go look at what happened.
Yeah, a whole lot of it.
I'm wondering if that was a change in capital gains tax rates or something like that.
Certainly capital gains income, because there's no doubt that the capital gains from all the stock options that were huge to the state.
Now, which, by the way, varies more, spending or revenue? Spending, which means that it's fluctuations in spending that are more responsible for deficits, or the change in the deficits, than fluctuations in revenue. In fact, it turns out that if we went back here, you've got, never mind, I'll save that point for later. So 20% seems to be a limit. But let's say you don't buy that. That's not a limit. By the way, Obama's budget projections don't see revenue breaching the 20% barrier out through 2019. Now, let's say you say, well, that's not really a limit, if there's a political will. Notice the highest taxes ever reached as a percent of GDP in U.S. history was when the U.S. was fighting World War II, a national emergency. They didn't even reach 25%. What does Obama's first budget come in as a percent of GDP? Anybody know? 28% of GDP. And that doesn't include all the TARP spending, because the TARP spending is put into the budget on a net present value basis, not on the amount of the total. Whenever the Treasury directly loans out money. Now, supposedly that's going to be reversed. By 2012, according to Obama's figures, federal spending will be back down to 22% of GDP. How likely is that, especially given what we know is coming down the pipe? Jump ahead here. Social Security and Medicare. All right? Here's an overhead I use to explain the Social Security system to my students. All right? One, send a big chunk of each paycheck to the name at the top of the list. Two, add your name to the bottom of the list. Three, upon retirement, you will receive thousands and thousands of dollars for the rest of your life. Four, do not break this chain or terrible things will happen to you. I think with this audience, I don't need to belabor this point, but here are the Congressional Budget Office estimates of Medicare and Medicaid and Social Security as a percent of GDP. If all other spending except interest on the debt remains constant out through, it's a 75-year projection out to 2082.
When was this projection?
This was just in the last year. This was
Net of stimulus of the plans that have already
Yeah, I'm not sure how much of that it includes.
Fascinating landscape.
I think this is after the TARP. I'm pretty sure this is after the TARP.
After TARP, before
Before
stimulus.
No, I think it's also after the stimulus. Yeah.
But I think before all the extra early retirements, Social Security system.
Yeah, right, yeah.
Yes.
This is probably known by most of you. Why is Medicare going up faster than Social
Well, Medicare, I guess the simplest answer to that is the Social Security is similar to the social insurance programs that other welfare states have. And even though it's projected to go up, I think, first of all, these estimates depend on projections about the future. So all of these agencies have optimistic estimates, pessimistic estimates. 25% of GDP is the cap on revenues. These numbers apply if all of a sudden we raise taxes now so that the deficit doesn't get any bigger. If the deficit starts to get bigger, then interest payments start to get bigger. And their projections of adding in interest payments on the debt have federal spending going up to between 44 and 75% of GDP. All right, so think about this. We've got tax revenue capped, seniorage revenue non-existent, and because of public choice incentives, politicians aren't going to fix Social Security or Medicare because they're both systems that are above reproach and beyond salvation. And that's why I'm predicting Treasury default. Now, when will Treasury default occur? I think that you can get a handle on that by noticing that the fiscal position of the government has two firewalls. All right? It currently has a firewall between social insurance, broadly conceived, including Medicare, and general expenditure, right, the regular budget. And that's provided by the trust funds. Now, I know that parts of Medicare are funded out of general revenue, but the most important part, hospital insurance, has its own trust fund. And the estimate is, the current intermediate estimate is that the hospital insurance trust fund will be entirely out of money by 2017.
I wondered, one of the factors on a default, obviously, is speed of the default, is attitudes and expectation on the part of investors.
Mm-hmm.
It strikes me that this current situation in New York, and of course California, we don't have to explain that to you, we may see defaults on the part of the state government. California is fundamentally defaulted for a short time already this year, but at some point the state government will default, it seems to me, far sooner than the federal government, because they can't print money, they have to have a balance.
Right.
So the question I guess I have is, if you started having significant number of large states defaulting, suppose you have 3 or 4 large states default, California, New York, Michigan is a classic.
Minnesota.
Yeah, whatever. The question I guess I have is, do you think maybe that might have an effect on investor attitudes towards debt?
Yes. Yes.
And sort of
definitely.
speed things along.
By the way, there is a period in which there were a significant number of state government defaults in U.S. history. In the late 1830s. What had happened is by the way, this is a cartoon that sort of summarizes my concluding point. In the previous couple of decades, the states had spent money on an orgy of canal construction. the Erie Canal was the first one that was built, and it actually turned out to be quite successful, proving the government can't even consistently do everything wrong. And that encouraged other states to follow suit. And what happened was that most of these states went into bankruptcy as a result of not earning sufficient money on their canal revenues. Plus, you had the Panic of 1837, and then you had a deflation from 1839 to 1843. And and all of the political consequences of that were wonderful because it encouraged states to pass balanced budget amendments, which actually still have an impact on state finances today.
It was a brilliant Friday the 13th talk.
There